actually start off discussing about this specific topic, which is the audit report. As I told you people that the agenda of the session today is going to be that I'll be discussing the audit report. I'll try to go through the entire audit report. Plus, in addition to the audit report, what I would try to do is I would try to attempt some of the examination questions also pertaining to the audit report. So let's actually start discussing. Okay, if I talk about the audit report, there is something that you actually need to have a quick recall because you people have already studied audit report at the F8 audit and assurance level. But again, I do understand that a lot of students they have probably forgotten whatever they have studied at the F8 level. Plus, some of you are coming from an exemption background, so you might actually not be aware of this. So let me guide you a bit. First of all, you people do have an idea that there are multiple ISAs that actually cover the audit report. And amongst the different ISAs that actually cover the audit report, that include ISA 700, that includes ISA 701, 705, 706, 710, 720. Plus, in addition to this, there is this ISA 560. There's this ISA 570, there's this ISA 580. So generally speaking, whenever we do talk about the audit report, these are multiple type of ISAs that actually cover the audit report. Green tea then. Now, what exactly are these ISAs all about? So let me give you a bit of a guidance. ISA 700 is about the audit report, or you could say it's actually forming an opinion on financial statement. That's what ISA 700 is all about. Then you've got ISA 701. And what is ISA 701? ISA 701 is key audit matter. Then there is this ISA 705. What is ISA 705? It is about modification to the audit report. Or you could rather say it's a modification to the opinion that we do with respect to ISA 705. Then you have got ISA 706, which is about the emphasis of matter and other matter. Then you've got ISA 710, which is the corresponding figures, which is probably not there in the course. 720, which is the other information. Then you've got ISA 560, 570, 580. So when you talk about ISA 560, ISA 560 is about the subsequent events. ISA 570 is about the going concern. And then ISA 580 is about the written representations. So when we actually talk about the audit report, these are the multiple ISAs that some way or the other have an impact on how the audit report is published. I repeat, so whenever we talk about the audit report, these are the different ISAs that actually have an impact upon how the audit report is actually prepared. Now, let's move a bit forward. Let's discuss further. Before I go on discussing about this audit report, let me recall that there are multiple types of opinions that an auditor provides. And what are those multiple type of opinions that the auditor provides? So the multiple type of opinions that the auditor provides, that could be categorized under the headings of unmodified, and modified. So what actually happens is that the different type of opinions that the auditor gives, they could be categorized into unmodified and they could be the modified opinion. So the unmodified opinion simply is when the auditor says that the financial statements give a true and fair view. So when you talk about the unmodified opinion, it's simply when the auditor says financial statements give a true and fair view, that is an unmodified opinion. When we talk about the modified opinion, there are three different types of modified opinions. And what are those three different types of modified opinion? One of them is a qualified opinion. The other one of them is the adverse opinion. The third one of them is termed as disclaimer of opinion. The third one of them is termed as disclaimer of opinion. So I've got three different types of opinions, which is a qualified opinion, an adverse opinion, and a disclaimer of opinion. What happens under the qualified opinion, the auditor says, except for financial statements give a true and fair view. So there are certain things which the auditor mentions that except for these items, the financial statements give a true and fair view. So whenever you have got a qualified opinion actually is like this, that the auditor says except for this, financials give a true and fair view. Then you've got what? Then you've got the adverse opinion. What exactly is there in the adverse opinion? So when I talk about the adverse opinion, auditor simply says that the financial statement do not give a true and fair view. Do not give a true and fair view. So when the auditor says that the financial statements do not give a true and fair view, that is considered to be an adverse opinion. And the third type of opinion that exists is the disclaimer of opinion. And in that disclaimer of opinion, the auditor says we do not express an opinion on financial statement. We do not express an opinion on financial statement. So generally, if I could just give you a bit of an idea, I could tell you people that what happens with respect to this. I repeat, I could actually tell you that what happens with respect to it is that whenever the audit opinion is being provided, I repeat, whenever the audit opinion is being provided, the audit opinion is being provided in this manner, in such a manner that ultimately it could be an unmodified, it could be a modified opinion, it could be a disclaimer, it could also be considered as a disclaimer, and furthermore it could also be considered as this qualified opinion. So these are the different types of audit opinions. So is everyone okay till now? In case if anyone has got any questions, do let me know. No, disqualified and unmodified are not the same. Okay, there are multiple questions. One of them is we don't have to remember the ISA numbers, right? No, you don't have to. Are disqualified and unmodified same thing? No. Unmodified means a clean opinion. Unmodified means a clean opinion. Okay, when do we have emphasis of matter paragraph? Amina Ali, just wait a bit. I'm going to guide you that when do we have an emphasis of matter paragraph. Don't worry about it. Yeah, don't worry about it. I'm going to guide you. When do we have an emphasis of matter paragraph? Now, basically, when we talk about audit report, so what I will do is I will take you through some of the extracts from the audit report so that you have an idea how the audit report is prepared, how the audit report is published, what are the contents of the audit report. Because at times the examiner do ask you a question And that questions requirement is generally like this, that you have to critically appraise or critically evaluate an audit report. So they at times give you an audit report and they ask you that critically appraise that. So see, let's discuss. First of all, this is a sample audit report. Every single company, every single audit firm who will be issuing an audit report in accordance with ISA will follow this. Every single entity who will be issuing the audit report in accordance with the ISA will follow this. So what does it say? The first one of them is independent auditor's report. This is what? This is the title. This is the title. So there is always going to be a title, that what exactly is the title to this statement, this report. The next thing is to the shareholders of the ABC company. Who are these shareholders? They are the addressee. Because you as an auditor are appointed by the shareholders, so your addressee are the shareholders. You as an auditor are appointed by the shareholders, therefore your addressee is the shareholder. Then report on the audit of financial statement. The third one of them is the opinion paragraph. So the audit report, it starts off with the first heading, which is the opinion paragraph. And the audit report, which is in front of you right now, is the one which is unmodified, is the one which is a clear audit report. It's not something which is a modified report. So generally, when we talk about the first paragraph or the audit report, the opinion, the first paragraph actually tells you that an audit has been performed. It gives you the company name, plus it actually tells you about the period also. So it tells you that it is actually an audit report. It provides you the company name. It actually mentions the period which is going to be covered. So that is all something that is mentioned, plus what is included in financial statement. Plus what is included in the financial statement. So all these four things are covered up. So whenever we talk about the opinion, always remember one thing, that the concept of audit opinion is that the audit opinion's first paragraph will majorly be an introduction paragraph. It will be mentioning that we have conducted the audit in accordance with the ISA for XYZ company for the period then ended of the financial statement, and the financial statement include this. So what you could do is that you could actually read through it. You could actually read through it. Okay, let's move a bit forward. So the first paragraph is majorly the introduction paragraph. What is it? It is majorly an introduction paragraph. Then you've got the next paragraph, and that next paragraph is actually the opinion paragraph. I repeat, this next paragraph is actually the opinion paragraph. And this is a sample audit report where there is an unmodified opinion. This is a sample audit report where there is actually an unmodified opinion. What exactly do you mean by an unmodified opinion? That the financial statements give a true and fair view. What does it do? Financial statements give a true and fair view. This is what this specific opinion tells you. So it says in our opinion, the accompanying financial statement present fairly in all material respects or give a true and fair view of the financial position of the company as at this date and of its financial performance and cash flow in accordance with the IFRS. So this is what it tells you. What does it tell you? It tells you that the type of opinion. So this is actually an unmodified opinion, and it says that the financial statements give a true and fair view. Now, so the audit report, no matter you are issuing it in Pakistan, you are issuing it in Uganda, you are issuing it in Zimbabwe, you are issuing it in London, you are issuing it in China, you are issuing it in Malaysia, this is the same format that's going to be followed. Now, the next one of them is the basis for opinion. The next one of them is the basis for opinion. Now, what exactly do you mean by the basis for opinion? Try to understand. The basis for opinion is that the basis on which the auditor is talking. The auditor obviously has got a certain base on which he is talking about. So generally you would find these things, that the auditor would mention that we have conducted the audit in accordance with ISA. Secondly, we are an independent auditor. We are an independent auditor. The third thing is that we have obtained sufficient appropriate audit evidence. Sufficient appropriate audit evidence. So we have actually obtained sufficient appropriate audit evidence in order to form an opinion. So generally, this specific paragraph, which is about the basis for opinion paragraph, would cover up these things, that the auditor would mention that this specific audit is conducted in accordance with ISA. We are an independent auditor in accordance with the code of ethics. Plus, we have obtained sufficient appropriate audit evidence. That is what all the things that the auditor is actually going to be talking about. Okay, let me know in case if any one of you have got any questions till now. You can read through this paragraph to see this. Okay, no one needs to run these. You don't need to learn these. You just need to know what is mentioned. Generally, what are the contents. You don't have to rote learn them. You don't have to replicate the audit report in the exams. It's just that the audit report is one of the component of the examination. That is what it is. That you should know what is mentioned in here, so that in case if the examiner says you have to critically evaluate, etc., etc., so you can do it. You cannot be asked to prepare an audit report. You could be asked to comment on an audit report. You could be asked to consider that what would be an appropriate audit opinion in the given circumstances. That could be asked. But you cannot be asked to reproduce an audit report. It's not something that is suitable for the professional level. Now, the next one of them is the third section, which is the key audit matters. Now, this specific element is actually covered up through ISA 701. I repeat, this is something which is covered through ISA 701. Now, what is this key audit matter? Let's try to understand. So, when we talk about the ISA 701, so ISA 701 talks about the key audit matter. I repeat, ISA 701 talks about the key audit matter. And what is the key audit matter? So when we talk about key audit matter, the key audit matter are those matters. Are those matters that are discussed with those charged with governance and are of such significance that auditor considers them so basically whenever we talk about the concept of key audit matter, what are the key audit matters? The key audit matters are those matters that are discussed with the management and those charged with governance, and in the auditor's judgment are of such importance that the auditor thinks that what we should do is that we should actually be, I mean, like what the auditor thinks is that the auditor thinks that we should actually be reporting these matters in the audit report. So that's what the key audit matter is all about. Now, So how do we write down the key audit matters in the audit report? I'll go about discussing more CAMs, but the way we go about is that we say key audit matter, that is a heading that you provide in the audit report. And then what happens is that there is an intro para, and then what happens is that discussion of each CAM. Now, what do we mean by discussion of each CAM? So, discussion of each CAM is going to be uh, for each of the CAM, you would say details about CAM, why is it a significant matter? So, there's something which is called details about CAM. The second thing is that why is it a significant matter? The third thing is that actions that auditor has undertaken in relation to this CAM. So what actually happens is that you talk about for each of the key audit matter, what you do is that you talk about these matters, that I mean, like, what is the matter? At the same time, why is it why is it a significant matter? And the third thing is that what actions you as an audit firm have taken in relation to these matters. What what actions you as an auditor have taken in respect of this matter. So like for example, let me give you a bit of an idea. Okay, is there an issue? Imran Makbul, are you having an issue? Okay, is anyone else having an issue? Yeah, ultimately the key audit matter would be a financial reporting issue. The key audit matter would be a financial reporting issue. I repeat, the key audit matter is always going to be a financial reporting issue. Okay, is it lagging? Is still lagging? Yeah. Neha Fatma, is it still lagging or is it okay now? Okay, is there anyone else having any issue? Because you see what happens is at times there could be a problem at one of the students' end, and ultimately, I mean, it may not be a problem at my end. If even a single student is able to hear clearly, then the issue is not at my end probably. Yeah, hello. Yeah, Imran. Okay, probably you need to, I mean, like, because you see what happens is this is a video that's being streamed. So it's not just the screen, it's a screen plus my video also. So maybe the internet bandwidth that is required is a bit higher. So probably you might try to disconnect and connect again and see if it changes. Okay. So what actually happens is you talk about the key audit matters in this manner, that you say, I mean, you talk about the key audit matter in this specific manner, that you say that what is the key audit matter, what is specifically the matter, why is it important. And the second thing is that the actions that the auditor has taken in relation to this specific matter. Now, for example, let me guide you a bit. For example, a company. has inventory spread across various places and it is a bit difficult to perform inventory count and quantify the inventory. Now, let me give you a bit of an idea. So there is a company which has got its inventory spread out into multiple locations, and it is becoming very difficult for the auditor to perform the count or to attend the test counts at every specific place. So what the and the inventory is a significant balance, and it is a significant balance. I repeat, it is actually a significant balance. So in case if the inventory is a significant balance and the auditor is finding difficulties in measuring it, then this specific inventory could be a key audit matter. The inventory valuation is judgmental. The inventory valuation is something based on estimates. So if there is something like this, that the inventory could be a key audit matter because there is a significant balance, humongous balance on the balance sheet of the entity. Let's move a bit forward. Now, so when you talk about the key audit matter, you discuss the matter, you discuss why is it an important matter, and then the audit procedures perform. So maybe possible that you might have attended the count. Maybe possible you would have obtained the third party confirmations. Maybe possible you would have reconciled the inventory, etc., etc. There could actually be multiple things that you might have done. So I repeat, in case if there are multiple things that you might have actually done, so you would mention them. You would mention them. So whenever we talk about the key audit matters, the key audit matters are part and parcel of the audit report and are mentioned in this specific manner. So you see here, it says, yeah, they have to be significant. They have to be significant issue. I mean, the significant word is beyond materiality. The materiality is essential. They have to be significant. I mean, they have to be high value. They have to be high risk item. They have to be very important item to be a CAM. A small item, a very immaterial item can never be a CAM. So you see, this is how you give an introductory paragraph and then you give a description of each of the key audit matter, that this is how the key audit matter is, this is what the key audit matter is. Kindly just look at it and confirm to me if everyone is okay. I know there are certain questions, I know there are problems, I will answer them. Don't worry, just wait a bit, just let me get through this ISA 700 first. No, my code of CAM is not the same as ML. ML is management representation letter. So amongst the matters that are discussed in ML, I repeat, amongst the matters which are discussed in ML, you as an auditor will have to exercise your judgment to decide which of these matters are significant matters and you make them CAM. Okay, now let's move a bit forward. Then there is this other information section in the audit report. And what is this other information section? Let me just give you a bit of a guidance about it. And I'll also tell you that how the other information is presented in the audit report. So you do have an idea that whenever a company publishes its financial statement, whenever a company publishes its financial statement, the financial statements are mainly published in the form of an annual report. I repeat, whenever a company publishes its financial statement, the financial statements are mainly published in the form of an annual report. So, how is this annual report? So, the annual report would have a lot of things. What are the lot of things? It would have the director's message, it will have a CEO message, it may have a 5-year forecast, it may have 10-year historical financial records, it may have different type of charts presenting the financial statement, presenting the performance, etc., etc. There could be multiple types of things that could be there in the annual report. And ultimately, at the very end, I repeat, and ultimately at the very end, what actually happens is that you come across the financial statement. And ultimately, at the very end, you come across what? You come across the financial statements. So generally, what happens is that if you are the user of an annual report, if you are looking at a company's annual report, so before reaching the financial statement, you would be going through all of these, all of these, all of these. So before reaching the financial statement, you will be going through all of these. So hence, resultingly, what is going to happen? Resultingly, what is going to happen is that there might actually be some information which is mentioned here, and you will pick up this information, like for example sales, for example EPS, for example PAT, for example gearing ratio, etc., etc. And what could actually happen is that this gearing ratio or the finance or the sales or the EPS or the profit after tax may be a bit different here. This may be a bit different here. Now there is something that you need to understand. I repeat, there is something that you need to understand here. What is that? That is, whatever information that accompanies, I repeat, whatever information that accompanies the financial statement, this is all considered to be the other information. This is all considered to be the other information. So what is an other information? So when we talk about other information, the other information is all the information other than the financial statements that are accompanying the financial statements is termed as other information. And when we talk about the other information, there is something that you need to understand, that there is an ISA, the name of which is ISA 720. There's an ISA, the name of which is ISA 720. The ISA 720 actually covers up other information. And what does ISA 720 says? ISA 720 says that the auditor does not report on other information, but the auditor has a responsibility to read other information, and in case of discrepancy, in case of any discrepancy, what do you mean by in case of any discrepancy? Discrepancy means that in case if whatever that is mentioned in the other information is different from whatever that is mentioned in the financial statement, then the auditor has to discuss with management and those charged with governance. If rectified, no effect on the audit report. If it is rectified, then there is no effect on the audit report. But in case if not rectified, I repeat, in case if it is not rectified, then you have to mention about the info where discrepancy or misrepresentation exists. So I repeat, auditor is not going to express an opinion on the other information, but the auditor has the responsibility to read the other information, and in addition to reading the other information, the auditor has a responsibility that in case if there is a discrepancy, in case if there is a problem, the auditor has to discuss this with the management and those charged with governance. If they agree to amend the financials, that is good enough. In case if they don't agree to amend the financial statement, the auditor has to make sure that he reports this in his audit report, referring to the specific statement, referring to specific portion of the other information that accompanies the audit report, that accompanies the financial statement, where this specific misrepresentation of the discrepancies exist. So just to give you people a bit of an idea, I've got this other information in this specific handout, and I'll take you people through that specific other information so that you do have an idea that what am I talking about. Okay, here you go. So in your audit report, what you would do is that this is the auditor's responsibility relating to other information. I repeat, this is the auditor's responsibility relating to other information as covered under ISA 720, as covered under ISA 720. And this is something that you have to read, that the auditor, what he would do is that he would mention that what is the response, who is responsible for preparing other information, what is the auditor's responsibility, etc., etc. Kindly go through it so that we could have a discussion. Yeah, yeah, in case if there is basically the other information which is accompanying the financial statement, in case if there are errors, in case if there are issues with that other information, then as an auditor, what you need to do is that you need to make sure that you mention about that discrepancy in the other information section. So this is something that you have to make sure that as an auditor you have to do with respect to it. Yeah, in case if anyone has got any other questions, do let me know or else I can move forward. Yeah, hello. Yes, I can share them. Yes, I can share them. Thank you. Okay. So guys, what is actually happening is we have got this ISA 720, which is the extract from ISA 720. So we have actually been able to discuss this specific element also, that what is it that you need to give with respect to the other information section. Now, the next one of them is the responsibility of the management and those charged with governance. So what are the three, four major things? They've got a responsibility to prepare financial statement. Thus, management has got a responsibility that they have to establish a system of internal controls. I repeat, the management has to make sure that they prepare financial statement. The management has to make sure that they establish a system of internal controls, plus what actually happens is that uh, they're also responsible for assessing the entity's ability to continue as a going concern. So you have to actually assess the going concern assumption too. Plus, those charged with governance are responsible for overseeing the management. So, under the responsibility of the management and those charged with governance, what are you going to mention? You're going to mention four things. One thing is that management is responsible for preparing financial statements, for establishing a system of internal controls. The third thing is that for ensuring that they make a proper going concern assumption. And the fourth thing is that those charged with governance have got a responsibility of overseeing the entire management. This is and the governance, they are responsible for overseeing the company's financial reporting process. Now, next is the auditor's responsibility. So, with respect to the auditor's responsibility, what is the auditor's responsibility? The auditor's responsibility is to express an opinion on the financial statement that whether they are free from material misstatement or not. Plus, the auditor mentions that it is not a guarantee that an audit conduct will always detect a material misstatement when it exists. So the auditor says that, see, we are an independent auditor. We will conduct the audit in accordance with ISA. We will make sure that we gather sufficient and appropriate audit evidence. Plus, plus what happens is that, plus what happens is that it is our responsibility to express an opinion on the financial statement, but expressing an opinion on a financial statement is not giving you a guarantee. Expressing an opinion does not give you a guarantee that financials are free from material misstatement, because we are performing the audit on a test basis. We are performing the audit on a risk assessment basis. So there could be errors, there could be issues that could exist with respect to the financial statement. So that is what the auditor's responsibility section is there in the audit report. You may actually go through it so that you could have an idea what the audit responsibility section is. Yeah, sure. Yeah, please. Yes, the live lectures are also going to be available on the portal. It's just that the session that I'm actually conducting is that there are certain topics that I just thought that I will be doing live in the class, so I'm doing them live in the class. All the live classes that are conducted will be made available to you on your web portal. You don't have to worry about it. Yeah, hello. Okay, just wait a bit. Do you know who is those charged with governance and who is management? Okay, basically what happens is that think about a company, think about a structure. This is board of director. The board of directors have got director 1, you've got director 2, you've got director 3, you've got director 4, you've got director 5. There could be multiple directors on the board of a company. Now, what actually happens is that if there are multiple directors on the board of a company, so what generally happens is that these board of directors, they actually seek reporting from the management. Who are management? So management is your HR manager, your finance manager, or you could say CFO, your chief operating officer, even your chief executive officer, even your chief marketing officer, etc., etc., etc. These are the people who are management. It is management's responsibility to prepare financial statement. It is management's responsibility to establish a system of internal controls. Those charged with governance are actually the board of directors. It's responsibility to oversee them. To oversee them. They oversee them. So important thing is that since we are talking about the audit report, the oversight actually means that they have got the responsibility that they got to see that the management, the way management is preparing the financial statement or the management is ensuring the financial reporting process is correct. So those charged with governance should be overseeing it properly. Do you get it now? No, no, auditor. Why would auditor give a financial statement? See, what happens is you as an auditor walk in. I mean, like, if you're talking about practicality, just ignore that. Just talk about the book right now, how it goes as per the book. You're an auditor. You would go to perform an audit. You will ask the management, give us the financial statements. The management will give you the financial statements. You'll perform your risk assessment. You'll obtain understanding of entity. You will actually plan the audit. You will perform the procedures. And after performing the procedures, you would discuss with management that look, this area in the financial needs revision. Some of the areas management would agree, some of the areas management would dispute, management would argue. The arguments would go on and on and on. And at the end of the day, you would reach a certain point where you, as an auditor, have to decide if you should give an unmodified opinion or a modified opinion. And you would issue the audit report. That's it. You, as an auditor, have no responsibility whatsoever with respect to financial statement. It's management's responsibility. They will prepare it. You will simply report on it. That's it. I hope that I have actually answered what you asked for. I'm hoping that I have actually answered what you asked for. Okay, great. So this is the auditor's responsibility section. Now, if I move a bit forward, and then what actually happens in this specific audit report is there is a heading which is report on other legal and regulatory requirements. Now, what is it? So every single country there is this Companies Act which is applicable. There's a company law which is applicable. And when we talk about a company law or a company act which is applicable, so that company law, that company act defines, actually tells you that, I repeat, that company law or that company act actually tells you that as an auditor you have to perform additional responsibility of verifying this item. Like I can tell you with respect to my home country Pakistan, and I can tell you because I know the Pakistani law, that's why I can comment on it. So, as per the Pakistani law, there is something the auditor also has to report that that the expenses are incurred for business, that proper books of accounts are maintained, etc., etc. There are multiple things that the auditor has to do, and they are the requirements as per the Companies Act, as per the Companies Ordinance or the company law. So whatever the requirements, the legal and the regulatory requirements that are prevalent in the country in which you operate, so as an auditor you got to incorporate that section also, mentioning about whatever the requirements of the law are. Lastly, the name of the engagement partner. I repeat, the name of the engagement partner. That whosoever is your engagement partner, you got to mention the name and the address and the date of the audit report. It's very important to mention the date of the audit report, that when exactly is the audit report signed. That when exactly is the audit report signed. So that is also important that you need to mention. So overall, conclusively, if I say that when we talk about the concept of an audit report, so this is in the simplest form a basic audit report that you as an auditor issue. There are obviously several types of modifications. There are several types of emphasis of matter, other matter paragraph, etc., etc. But in general, this is what you need to keep in mind as an auditor, that an auditor who is actually going to be issuing an independent auditor report, it will be in this specific format. We'll, we are now going to move on and discuss about the modifications to the audit opinion. I repeat, we are now going to move forward and start discussing about the modifications to the audit opinion. So these modifications to the audit opinion are covered by ISA 705. Now let me start discussing what the concept of modification is all about. I repeat, let me start discussing the concept of modification. Whenever we talk about the concept of modification, the modification actually means what? The modification, as I said, that there could be three different types of modified opinion, which could be either qualified opinion, which could be an adverse opinion, and that could be a disclaimer of opinion. So as I repeat, there could be three different types of modified opinions. It could be qualified, it could be adverse, it could be disclaimer. Let's talk about it. Let's start discussing about it. So when I talk about the qualified, adverse, and the disclaimer of opinion, let me guide you a bit. These different types of opinions, whether it be qualified or adverse or a disclaimer, would depend upon the reason for modification. Would depend upon reason for modification. So always remember, the modification is because of two reasons. I mean, it could be either because the financial statements are materially misstated, or it could be because the auditor is unable to gather sufficient and appropriate audit evidence. So I repeat, always remember the modification is going to be because of either of these two reasons, which is number one, the financial statements could be materially misstated, or number two, your inability to gather sufficient and appropriate audit opinions. Now, when we talk about the financial statements being materially misstated, or when we talk about inability to gather sufficient and appropriate audit evidence, so there is one more thing which we need to understand, which is the concept of the terminology pervasive. The concept of the terminology which is called pervasive, discussed in ISA 705. What do we mean by pervasive? When we talk about pervasive, so pervasive actually is defined as a matter. I mean, in accordance with the ISA 705, you would realize that the term pervasive will actually be used when what? Pervasive effects on financial statement are those that in the auditor's judgment, So again, it's the auditor's judgment which would decide if the matter is pervasive or if the matter is non-pervasive. I repeat, it's the auditor's judgment which will decide if the matter is pervasive or if the matter is non-pervasive. Number one. Number two thing that you need to keep in mind is that it says the matter is pervasive if the if the effect are not confined to specific elements, accounts or items of the financial statement. Are not confined. Not confined means this simply actually means there are multiple errors, there are multiple misstatements, there are multiple items which have got an issue, which have got an error. So I repeat, when you've got multiple items which have got multiple elements which actually have an issue, so that means this is going to be an area which is going to be termed as pervasive. See, the receivable is misstated and the sales are misstated. This is not multiple issue. This is one issue. But your receivable is misstated, your payable is misstated, your cash balance is misstated. This is a pervasive issue. This is multiple issue. These are multiple issues and this is a pervasive impact. This is a pervasive effect. Next. So one thing is an effect is pervasive if it is pertaining to multiple elements. Number two. If so confined, what do you mean by if so confined? Like if it is confined to a specific thing. If so confined, like if it is confined to specific things, represent or could represent a substantial portion of the financial statements. Like for example, if there is a single misstatement, if there is a single issue, but that is actually a substantial proportion of financial statement. What do you mean by substantial proportion of financial statement? It is not defined in any book. It's just a judgmental thing. Generally, what happens is 25% of net assets is considered to be substantial. 25% of net assets is considered to be substantial. So like for example, you've got misstatements in inventory and the inventory constitute 40% of the total net assets. So you would say that a 40% of the total net assets are misstated. So if 40% of total net assets are misstated, this is a pervasive impact. For example, there is a subsidiary which constitutes 30% of your net assets and you have not consolidated it. So that means there are multiple elements that are misstated. You see, there are multiple elements that are misstated. Now, in relation to disclosures are fundamental to users' understanding of financial statement. At times, the pervasive impact could be related to a certain disclosures. I repeat, at times the pervasive impact could be in relation to certain disclosures. What do you mean by this? When we say that it is pertaining to certain disclosure, like at times the going concern disclosure could be wrongly provided, could not be properly provided. Maybe possible at times what happens is there is a contingent liability which is not appropriately provided. So there could be multiple issues, there could be multiple areas, there could be multiple problems that could happen. So I repeat, you got to see if the matter is pervasive or not. I repeat, you got to see if the matter is pervasive or not. So when we talk about the matter to be pervasive, what do we mean by this? A pervasive matter means it's either multiple elements that are misstated, or number two, it is representing a substantial proportion of the financial statement, or number three, that it is fundamental to the understanding of the users. So either of them would actually give you a pervasive impact. Now, how exactly are we going to deal with the misstatement? So for the misstatement, let's try to understand. ISA 705 says that you need to identify the reason for modification. Is it that financial statements are materially misstated, or is it inability to obtain sufficient appropriate audit evidence? What is the reason? Are you unable to obtain the evidence, or are the financial statement misstated? Now see, first and the foremost thing is that the matter has to be material. I repeat, the first and the foremost thing is matter has to be material. But the second important thing is that is it pervasive or is it not pervasive? So for example, if it is not pervasive, then in both the cases it's a qualified opinion where you would say except for the effects of this financial give a true and fair view. Except for the effect of this financial will give a true and fair. But if the matter is pervasive and you are unable to, and the financial are materially misstated, it has to be adverse opinion. Number two, if the matter is pervasive and you are unable to obtain sufficient appropriate audit evidence, then it has to be a disclaimer of opinion. I repeat, it has to be the disclaimer of opinion. Okay, I'll repeat it. First thing is, if the matter is not pervasive, if the matter is not pervasive, then it's a simple qualified opinion in both cases, whether there is material misstatement or whether you are unable to gather sufficient appropriate audit evidence. Number two, the matter is pervasive. The inventory is a significant portion of the financial statement and the inventory value is misstated. So as an auditor, you would say financials are materially misstated. Matter is pervasive. I'll give an adverse opinion. I'll say financial do not give a true and fair. Number two, there is an entity subsidiary and I am unable to gather. I repeat, there is an entity subsidiary and I am unable to gather sufficient and appropriate audit evidence pertaining to that subsidiary, and that subsidiary is a substantial portion of the entity's assets. So that means it's a case of inability to obtain sufficient appropriate audit evidence having a pervasive impact. So it simply say disclaimer of opinion, which is we do not express an opinion, which is we do not express an opinion. Do you get it now? Now, so when we actually have got these modifications, so there is an amendment, there is a change to the change to the audit report. First of all, your opinion, the heading for the opinion is gonna change. It's gonna become either qualified, adverse, disclaimer, whatsoever. So you'd say qualified opinion. Say it's qualified opinion. And with respect to qualified opinion, you are gonna say the first paragraph would remain the same. But in the other paragraph, you would say, in our opinion, except for the effects of the matter described in the basis for qualified opinion section of our report, the financials give a true and fair view. Except for the effects of the matters discussed in the basis for qualified opinion section of our report, financial statements give a true and fair view. And then the basis for opinion would become basis for qualified opinion. The basis for opinion is gonna become basis for qualified opinion. The basis for opinion would become basis for qualified opinion. And what are you gonna mention? You're gonna mention here now what? You will mention now the specific item, carrying amount of that item, the correct accounting treatment, and the effect of rectification. You're gonna mention all this. I bet you're gonna mention all this, which is which specific item is having an issue, what is the carrying amount of that item in financial statement, what should have been the correct treatment, and what are gonna be the effects of rectification. Now see, it says the company's inventories are carried in the balance sheet at this amount. This is the carrying amount. You're mentioning about inventory. Management has not stated the inventories at the lower of cost and NRV. So you're talking about the correct accounting treatment, but has stated them solely at cost, the error that's there, which constitutes a departure from IFRS, which constitutes a departure from IFRS. The company's records indicate that had the management stated the inventories at the lower of cost and NRV, an amount of this would have been required to write the inventories down to their NRV. Accordingly, cost of sale would have increased by this, and income tax, net income, shareholder equity would have reduced by this. So this is all that you have to incorporate, which is the item, the carrying amount, the Correct accounting treatment, the error, the effect of rectification, everything has to be mentioned. Aditya, just wait a bit. Then you have got an adverse opinion, which is again the same thing, everything same. Now the opinion heading is adverse opinion. And then you have got, in our opinion, because of the significance of matter discussed in, basis for adverse opinion section, the company consolidated do not present fairly so and so so and so. Then you have got the basis for adverse opinion. So you will talk about the basis for adverse opinion, whatever the basis. You could just see that there is a basis that the group has not consolidated a subsidiary. So if you don't consolidate a subsidiary, this means that multiple material misstatements are there. And multiple material misstatements would mean a pervasive impact, and hence the adverse opinion has to be there. Then you've got another qualified opinion. This time it's basically probably inability to gather sufficient appropriate audit evidence. That is what the basis for opinion is mentioning. And lastly, there is a disclaimer of opinion. And with respect to disclaimer of opinion, just remember two things. You would not give a chem, and you would not include the other information section. These two sections of the audit report are not going to be included. I repeat, whenever you've got a disclaimer of opinion, these two sections of the audit report will not be provided. Why? Because when we talk about the CAM, when we talk about other information, we are more or less saying that these are okay, this is okay reflected in the financial statement. So we're not giving any opinion. Our opinion is not expressed when it comes to disclaimer. That means we don't want to give an opinion. So if you don't want to give an opinion, that means this is what it is going to be. Yeah, is everyone okay now? I repeat, is everyone okay now? Okay, Gary, what's the issue? Yeah, Gary, let me know what's the issue. Where are you having an issue? Okay, you see, when we did actually include the other information, just let me take you to the other information section. When we included this other information section in our audit report, um, we said management is responsible for other information. The other information comprises so and so, so and so. Our opinion on financial do not cover other information. It says in connection with our audit of financials, our responsibility is to read so and so, so and so, so and so, and so consider whether other information is material. If based on our work we have performed, we conclude there is a material misstatement of this other information, we are required to. We have nothing to report in this regard. That means you are sort of giving an opinion when it comes to other information. You are saying we have nothing to report in this regard. So this is other way around an opinion, that you are some way or the other giving an opinion. And when you have a disclaimer of opinion and you give this thing, this is a contradictory statement. This is a contradictory statement. So that's why you avoid it. Do you get it now? Okay, Kemi, do you get it now? Gary, do you get it now? Are you people okay with it now? Okay, good enough. Lovely. So as I told you people that you have got another ISA, the name of which is ISA 706. And this ISA 706 is about emphasis of matter para and other matter para in the independent auditor's report. So ISA 706 is emphasis of matter paragraph and the other matter paragraph which is actually presented in the audit report. Now see, let's see the definition of emphasis of matter para and the other matter para. So it says emphasis of matter paragraph, which is also commonly known as EOM, a para included in the auditor's report that refers to a matter appropriately presented, a very important point, appropriately presented or disclosed in the financial statements, that in the auditor's judgment is of such importance that it is fundamental to users' understanding of financial statements. So the focus has to be a matter which is appropriately presented and disclosed and accounted for in the financial statements, but the auditor thinks that it's an important matter to report to the people who are reading the audit report, so that's why includes it. Okay. That means, let's say a company is not a going concern and the entity has prepared financial statements on a breakup basis. That means management is saying we are not a going concern. They've correctly disclosed. They've done everything right. So as an auditor, you would say it's such an important matter that I think that we should reflect, we should draw attention of the users to this specific section of the financial statement, that look, the entity is not a going concern and the management has correctly accounted for it. So basically the concept is, if a matter is very important and the management has correctly accounted for it, you would go for emphasis of matter paragraph. You would reflect that in the emphasis of matter paragraph. Next, there is this other matter paragraph. There's this other matter paragraph. It says a para included in auditor's report that refers to a matter other than those presented or disclosed in financials. I mean, this is something other than what is reflected in financials, outside financials, other than financials. That in auditor's judgment is relevant to users' understanding of the auditor's responsibility, or the auditor's report. So I repeat, what actually happens is that the other matter paragraph, it's a para included in the auditor's report that refers to a matter other than those that presented or disclosed in the financial statement, that in the auditor's judgment is relevant to the users. Now, generally what happens with respect to the other matter is that mainly if it's a first year of audit, mainly if last year financial statement were audited by another auditor, or maybe let's say another set of financial statements auditor has issued report on another set of financial statement, that is all gonna be something that would be considered as, I repeat, that is all gonna be something that would be considered as what? That is all gonna be something that would be considered as the factors that would give rise to other matter paragraph. The factors that would give rise to other matter paragraph. Do you get it now? Yeah, do you get it now? Okay, now see, how do we present these EOM and the other matter paragraph in the audit report? So I'm probably assuming that I have included one of the sample. Yes, Alhamdulillah, I've got the sample here. So there is an emphasis of matter paragraph and this is another matter paragraph. You could read through both of them that how it is actually there. So with the emphasis of matter paragraph, we draw attention to note X. So you got to refer to the specific note of the financials which describe the effects of the fire in the company's production facilities. Our opinion is not modified in respect of this matter. Means an item which is correctly presented in financials, but the auditor thinks that it requires attention, so the auditor has included this. Then there is this other matter. Financials of ABC company for the year ended 31st December 20 were audited by another auditor who expressed an unmodified opinion on those statements. So the other matter paragraph is something that has nothing to do with the financial statement. It's something which is other than the financial that the auditor wishes to talk about. It's something other than the financial statement which the auditor wishes to talk about. That is what it is. So do you people get it? What's an emphasis of matter para and what is other matter paragraph? Okay, now I will start discussing a very important concept and a lot of the students have got an issue with this, which is what exactly is the difference between the key audit matter and the emphasis of matter paragraph. A lot of the students have got this issue. They don't know what exactly is the difference between CAM and what exactly is the difference between EOM. Now see, a key audit matter is a matter which in the auditor's judgment was of such significance that he wishes to refer this in the audit report. The emphasis of matter was a matter which was correctly accounted for and was important matter in the auditor's judgment that he thinks that he should include this in the report. So for the time being, when we actually read through both of them, CAM and EOM, apparently they both seem to be the same thing. But again, there is a lot to the key audit matter that you need to understand. The key audit matter, I mean, I'm just trying to explain this in a very layman terminology. I can get into a lot of details, but it is gonna get complicated. So, the key audit matters are reflected in the audit report at two places. What are those two places? One of them is the CAM section, and the other one of them is basis for modified opinion section. I repeat, the key audit matter are actually reflected in the audit report at two places. One of them is a CAM section and the other one of them is basis for modified opinion section. So if a matter is correctly accounted for, then it's shown under the CAM section. But if there is a error and if there is an issue, so it's basically it could lead to a qualified opinion, it could lead to an adverse opinion, or it could actually lead to a disclaimer of opinion. So I repeat, the key audit matters. So you need to understand one thing, the matters which actually lead to modification are the key audit matters. So if there is something that leads to modification, it has to be a key audit matter. Now, a matter which is correctly accounted for will be presented under CAM section. A matter which leads to modification will be presented under the basis for modified opinion section. Now see, again the problem that arises is that what exactly is the difference between this CAM and the EOM? Why do we need EOM? Why do we need CAM? So the major difference between EOM and CAM is that the CAM is a high risk transaction, high risk item, high risk element from the perspective of the auditor. Whereas EOM is being provided on the elements which are low risk. So if I go on to audit a company And I know that there is a huge amount of contingent liability that needs to be disclosed. And the management has disclosed it, and I consider it to be a low risk transaction because I think management has correctly accounted for it. I will give an EOM. Number two, I go on to the audit. There is a contingent liability, and I have doubts over the amount that the management has presented. And I consider this as specific to be a very high risk area for my audit. So I plan proper procedures on them. I perform proper procedures on them. I get into those things. And then what actually happens is that there could be two things. Either I would completely agree with the management, or I might not agree with management and I might discuss this matter with them. They might actually make certain amendments and they satisfy my requirements. So again, that is going to be a CAM. Matter is correctly presented, but it was a high risk matter. I have performed several procedures on these matters, so it is going to be reflected in the CAM section. But in case if it's a low risk item from the perspective of the audit, it would be shown in the EOM section. And you know it that when it comes to the CAM section, you give a description of the matter, plus you mention about the audit procedures, etc., etc. But when it comes to EOM, all that you have to do is that a single para, which is just reflecting to a relevant note where the relevant items are reflected. So that's where the major difference between EOM and the CAM lies, and a lot of the students, they find it difficult to understand that what exactly is the difference. So here you go, the difference. This is what the difference is.